Across global markets today, a quiet technical decision is reshaping how commodity risk moves across continents. The Indian IFSC board cleared a new global commodity trading platform at GIFT City, signaling a potential shift in where price discovery happens for metals, energy, and agri-goods. Investors are watching because the move could reduce settlement friction, boost liquidity, and attract foreign brokers who once avoided Indian venues. In a world where institutions chase efficiency and transparency, a dedicated platform at a tax-friendly, regulated zone could become a credible alternative to traditional exchanges. The implications reach hedgers, miners, traders, and long-only funds alike. At the core, the plan is to host a centralized venue where buyers and sellers trade physical or commodity-linked instruments under a single regulatory umbrella. The platform at GIFT City would connect global banks, brokers, producers, and funds, providing standardized contracts, transparent clearing, and faster settlement cycles. Think of it like a global online marketplace for essential inputs. It does not replace existing exchanges, but complements them by offering cross-border access, lower counterparty risk through robust clearinghouses, and smoother currency conversions. The move follows a broader push toward digital infrastructure in Mumbai, Delhi, and beyond, aligning India with international trading norms. India has long aimed to build financial rails that rival Singapore and London for capital flows. GIFT City was conceived as a technology and tax-friendly hub for international business, with a dedicated IFSC sector designed to attract offshore trading and financial services. The potential commodity platform echoes earlier experiments such as exchanges attempting cross-border contracts and private networks linking producers with buyers in Asia. Historically, price discovery has relied on a mix of domestic futures, over-the-counter deals, and regional bourses. The new blueprint mixes digital clearing, unified KYC checks, and a sovereign backing to reassure global counterparties. Initial market chatter hints at a liquidity premium rather than a price shock. Global banks and commodity funds monitor the development for potential cross-listing and hedging efficiency. Traders compare the plan to landmark shifts seen when a major exchange opened in a new region, which historically boosted trading volumes by double digits within months. If the platform proves credible, you could see tighter bid offers, narrower spreads for energy and metals, and improved price transparency across time zones. Even if adoption takes years, the mere possibility supports more accurate signaling for miners, refiners, and end users who manage real assets. Impact spreads across producers, traders, banks, and funds with different incentives. Integrated majors in metals, oil, and agri-inputs could gain lower hedging costs and cross-border access, enabling more flexible supply contracts. Financing windows might widen as banks deploy more capital to structured trades, while mid-cap commodity traders seek economies of scale through shared clearing. Asset managers, pension funds, and sovereign wealth funds could reallocate toward listed platforms or synthetic exposures that capture efficient price discovery. Retail platforms may also ride the wave via index products and ETFs tied to broad commodity themes, expanding participation beyond specialist users. Geopolitical currents and macro shifts frame the backdrop for any platform based in a BRICS-adjacent city. Inflation trends, currency stability, and trade frictions influence appetite for cross-border clearing. A clearer trading infrastructure can reduce the risk of FX gaps during volatile sessions, a factor prized by multinational miners and refiners. Meanwhile, regulators in Europe and the United States scrutinize shadowy over-the-counter flows, pushing a push toward auditable, standardized contracts. The GIFT initiative aligns with India's broader push to become a global financial hub, while a softer dollar or rising commodity demand in Asia could accelerate adoption. Smart money is looking for hedges between risk and efficiency. Institutional buyers are testing pilots with cross-border clearing and temporary liquidity lines, watching for reliable settlement feeds and cost savings. Pension funds and sovereign wealth funds may allocate small initial exposure, then scale as data shows stable performance. Retail interest tends to rise once custody and ETF wrappers offer liquid access. Analysts point to potential volatility if regulation tightens or if primary listings lag. Some hedge funds may deploy algorithmic strategies to arbitrage price gaps between domestic futures and the new platform, chasing predictable spread collapse when volumes grow. Despite the optimism, risks loom. A new platform faces onboarding delays, persistent liquidity gaps during early phases, and friction from legacy brokers resisting new operational models. If counterparty risk is not fully mitigated, sudden flash crashes could spill across both domestic markets and cross-border trades. Cybersecurity incidents, data integrity failures, or mispricing due to fragmented liquidity could undermine confidence. Regulatory overreach or inconsistent tax treatment might deter global participants. A quick rollback or policy reversal could erase early benefits, pushing capital back to familiar exchanges and leaving traders with stranded contracts and higher clearing costs. The window for careful rollout is narrow. Retail investors should treat this as a structural story rather than a quick flip bet. Start with education, read the project white papers, and track regulatory milestones, including approvals in related jurisdictions. Consider exposure through broad commodity index funds or ETFs that emphasize liquidity and diversification rather than single contracts. Avoid chasing hype into thinly traded segments. Wait for meaningful volume and credible clearing disclosures. Use risk controls such as position limits, stop losses, and transparent cost structures. Finally, compare costs across venues and prepare a staged entry plan rather than a one-time allocation. Diversify across energy metals and agriculture to reduce single contract risk. Looking ahead, the GIFT City platform could become a corridor for cross-border trade, accelerating price transparency and potentially diversifying the global commodity ecosystem. The timetable remains uncertain, but momentum is building as regulatory and technical milestones stack up. If successful, the platform may attract liquidity, lower funding costs, and encourage more hedging channels for farmers, miners, and manufacturers alike. The key for investors is discipline. Monitor adoption curves, verify clearing standards, and separate hype from data. Markets will adapt as data confirms resilience.